Imagine you want to bring a Fortune 500 CEO to their knees. You've got two options. First, buy a controlling stake, spending billions of dollars you don't have. Second, become Carl Icahn and launch a corporate raid. But there was a third option. The option of a man who didn't run a hedge fund, didn't sit on a board of directors, and didn't have an MBA. In the 1990s and 2000s, Reverend Jesse Jackson, the figure you're used to seeing at protest marches, pulled off what analysts would call a hostile takeover of America's corporate culture. He forced giants like Toyota, Citigroup, and Coca-Cola not just to listen to him, but to pay him. This isn't a story about civil rights in the usual sense. This is a story about how one man understood Wall Street mechanics better than the bankers themselves. He realized that in the age of globalization, reputation is an asset you can short. Today we'll break down how Jackson turned social justice into a financial derivative and why the modern HR departments at Google and Apple operate by rules he wrote 20 years ago. Lever 1. Shareholder Activism, the one-share strategy. In 1997, Jackson launched the Wall Street Project. His thesis was simple. Sharecroppers are becoming shareholders. He moved the battle from the streets into boardrooms. But how do you get into the room where decisions are made if you're not invited? Simple. You buy a ticket. Jackson's strategy leaned on SEC Rule 14a8. It allows shareholders who have held as little as $2,000 worth of stock, and in some periods even less, for a year to submit proposals for the agenda of a company's annual meeting. Jackson and his coalition began buying the minimum shareholdings in 50 of the largest corporations. That gave him the legal right not just to attend meetings, but to demand answers from the CEO in front of every investor. It was elite-level, totally legal trolling. Picture it, a boring discussion about dividends, and then Jackson stands up and asks why there isn't a single person of color on the board, while the company makes billions off those markets. Executives hated it, but they couldn't throw him out. He was an owner, and those proposals, even when they didn't win a majority, created what corporate governance calls nuisance value. It's easier to cut a deal with the activist and pull the proposal than to publicly debate racism in front of Bloomberg and FT reporters. That was the first lesson. You don't need to own the company to control its agenda. You just need enough shares to turn the microphone on. Lever 2. Economic deficit, the market share threat. But a microphone isn't power yet. Power is a threat to profits. Jackson switched the rhetoric. He stopped talking about morality and started speaking the language of McKinsey and Deloitte. He told Wall Street, "You have a vision deficit disorder." His argument was purely capitalist. Black and Latino communities aren't a problem. They're an emerging market with $600 billion in purchasing power. Ignoring it means leaving money on the table. In 1981, he used a tactic he euphemistically called a national withdrawal of enthusiasm against Coca-Cola. Translation, a boycott. Coca-Cola started losing money. So what did they do? They didn't just apologize. Within a month, they agreed to invest $34 million in black-owned businesses. The same story repeated with Toyota in 2001. Because of a single ad that was seen as offensive, the threat of a boycott loomed. The result? Toyota, fearing market loss, announced a $7.8 billion diversity strategy. Jackson proved he could move ROI, return on investment. In the Anheuser-Busch case, the boycott ultimately led to Jackson's sons becoming owners of the largest beer distribution center in Chicago. Critics called it extortion, but from a business perspective, it was a brilliant trade. Exchanging political calm for a slice of the market. Lever 3. Institutional shame, the report card system. The third lever was the most subtle. Jackson introduced a system of report cards. His organization, Rainbow Push, began grading entire industries, from automotive to tech, assigning them color codes: green, yellow, red. For a corporate lawyer or PR director, a red rating in that system was scarier than a lawsuit. You can win in court, but the label of racist company in a public report scares off investors and ESG funds. In 2022, General Motors and Toyota received green grades. Why did they try so hard? Because Jackson built a system where institutional shame became a quantifiable metric. Companies started competing over who was more inclusive, not for justice, but to avoid reputational risk. It was a genius bureaucratic trap. To get a strong rating, companies had to disclose data on hiring, procurement, and board composition. Transparency became a weapon. The shadow impact, the legacy in Silicon Valley. You might ask, why does this matter today? A lot. In 2014, Jackson showed up in Silicon Valley. He attended shareholder meetings at Google, Facebook, and eBay, demanding they release workforce data, EEO-1 reports. Sheryl Sandberg at Facebook tried to dodge it, but Google caved first. David Drummond at Google publicly admitted, "We were wrong," and released the data. After Google, Apple, Yahoo, and LinkedIn followed. Today, when you see minority-owned financial firms participating in the IPOs of giants like Facebook, 2012, or Uber, that's a direct result of the Wall Street Project. Jackson built an infrastructure where access to deal flow became a mandatory entry tax into respectable Wall Street society. The Jesse Jackson story on Wall Street teaches us one key lesson about the nature of power. You don't need to own capital to control it. You need to know how to create risk for the people who do. Jackson didn't build factories or write code. He built an architecture of pressure where social capital converts into financial capital at a very favorable exchange rate. He showed that in the modern economy, access to capital matters more than abstract rights. And while critics argued about his methods, he permanently changed what the boardroom of your favorite company looks like.